Every parent in the world dreams of saving up a nice pot of cash so that when they pass on through to the other side, their kids can pay off all their debts and be financially free forever. But there's one thing standing in the way of that dream: inheritance tax. And unfortunately, in my 15-odd years as a financial advisor, I have seen people literally lose millions of pounds because of it. So, in this video, I am going to explain what UK inheritance tax is, how it works, and what has changed in 2025. And then I'll give you 5 tips on how to avoid it so that you can give more money to your kids and less to the taxman. So, first things first, what is inheritance tax? Well, let's imagine that over your lifetime, this represents all the money and worldly possessions you have accumulated. Your house, your savings, your investments, even that vintage car you've been tinkering with in the garage, or the ever-growing guitar collection that your wife nags is taking over the house.
What? They're family heirlooms.
Now, ideally, you would just give this to your kids, but that would be too easy. So the government will tot up all of your worldly possessions, and if the total value exceeds a certain threshold, HMRC comes knocking, and they will take a big fat slice of your pie. Now, I know what you're thinking, but Tom, haven't I already paid taxes on all of this stuff all my life? Well, yes. But sadly, the government couldn't care less, because HMRC are greedy gannets who love going for second, third, and even fourth helpings. And when you die, the taxman views this as a transfer of wealth, and in their eyes, that's a taxable event. So to explain how this works in real life and add some context, I'm going to tell you a typical story of one of my clients. Meet Roger and Rebecca. They're a successful couple in their mid-60s, living in a lovely home just outside London. Roger's had a great career in finance, while Rebecca built up and sold a small tech company. So their estate currently looks something like this. Main residence, £900,000. Saving and investments, £1.5 million. Holiday cottage in the Lake District, £350,000. Personal pensions, £1 million. And personal possessions, which includes Rebecca's collection of vintage wines, £250,000. So their total estate value is £4 million, which I think we can agree isn't too shabby. But this is before HMRC comes to spoil the party. So let's see what would apply to Roger and Rebecca's estate if they both died today. Wow, this is a morbid video. Well, first we have something called the nil rate band. This is the amount that's automatically tax-free for everyone. It's currently set at £325,000 per person. And a little fun fact for you, it's been set at £325,000 since 2009, which is often criticised as it hasn't moved on with inflation, which means more people get sucked into inheritance tax year on year. If it had moved with inflation since then, the nil rate band should be about £500,000 by now. Not sure fun was the right name for that fact, but anyway. Since Roger and Rebecca are married, they can combine their allowances. So that's £325,000 times 2, giving £650,000 tax-free right off the bat. Then we have something called the residence nil rate band. This is a relatively new feature to the inheritance tax regime, being introduced back in 2017. This extra allowance applies when you're passing your main home to your direct descendants. Now, there's a whole definition of who is a direct descendant on the HMRC website, but broadly speaking, it's kids, grandkids, stepkids, adopted kids, etc. Have a look at the full list if you're not sure. Note, it doesn't include nephews, nieces, or siblings, for example. It's currently £175,000 per person, so that's potentially another £350,000 tax-free. However, for estates over £2 million, as is the case in this example, the residence nil rate band is reduced by £1 for every £2 over this £2 million figure. Roger and Rebecca, therefore, would in fact lose all of this allowance and instead only benefit from the basic nil rate bands only. So, as we've established, Roger and Rebecca can pass on £650,000 of their estate 100% tax-free. But here's where it gets painful, because everything above this threshold is taxed at 40%, except their personal pensions. Well, not for long at least. More on this in a minute. So, if we take out the £1 million in pensions from the £4 million Roger and Rebecca are worth, The remaining taxable estate is going to be £3 million minus the £650,000 in total allowances, gives us £2.35 million net estate value, which is what the tax bill will be worked out on. The rate of inheritance tax is 40%, and so the tax due on this estate will be 40% of £2.35 million. In other words, £940,000 will go straight to HMRC instead of into their kids' pockets. A pretty brutal cheque for the kids to have to write. And what's worse is that HMRC want to be paid before they distribute any of the estate, which can cause all sorts of problems. A topic for another video, perhaps. So what is the alternative? Well, let's take a look at 5 things you can do to make sure your money goes to better use. So, as we established, inheritance tax is only charged on the assets you own when you die. But if you spend your money on experiences like holidays or fancy dinners, that money isn't there to be taxed later. And if I'm honest, this is the first piece of advice I would give to anybody with that level of wealth. Live life to the fullest. Not by buying material things like classic cars, watches, or guitars for that matter, because they would still form part of your taxable estate, but on experiences and memories. So, in Roger and Rebecca's case, they could decide to splash out £500,000 on amazing trips, seeing the Northern Lights, going on safari and taking luxury cruises. This would reduce their estate from £3 million to £2.5 million, which would create a taxable estate of £1.85 million after applying the bands mentioned earlier, which would lower the tax bill to £740,000, a potential saving of £200,000 in inheritance tax. Plus, they get to enjoy their hard-earned money and create lasting memories with their kids, or without them. It's up to them. But at least it's money well spent either way. Could take me, of course. Secondly, and this might sound strange, but you can actually insure against inheritance tax. So, in the case of Roger and Rebecca, they could take out a life insurance policy which would pay out the amount to cover their potential tax bill, £940,000 in this example, or maybe £740,000 if they took me on holiday. This policy would be a big help to Ron and Rachel. Those are the kids, by the way. It would most likely be a whole-of-life policy that would pay out on second death, but we won't get bogged down in that level of detail for now. Now, it probably wouldn't be cheap, but let's imagine they pay, say, £3,000 a month in premiums, which might sound bonkers, but when the second of them passes away, this policy will pay out £940,000 tax-free, which can be used to cover the inheritance tax bill. They could even write the policy in such a way that the amount of cover increases over time to reflect the ever-growing nature of their assets, if they really think they can't spend them down. However, the key to this strategy, and don't get this wrong for goodness sake, is to have the policy written in trust. When the policy is written in trust, the payout doesn't form part of the estate as it is paid out into the trust and not into the estate. This is therefore not subject to inheritance tax. This is super important. The trust can then use this money to pay the inheritance tax bill, effectively reducing the net cost of IHT to however much all the premiums that were paid for the policy totted up to, instead of £940,000, as is the case here. Let's say they had the policy for 15 years, and then the second of them died. They would have paid £540,000 in premiums and got a payout of £940,000. Not bad. For number 3, I'm going to recommend you be a bit more generous while you are still here. Because if you give away money or possessions and then live for 7 more years, that gift, which is something called a potentially exempt transfer, or PET as you might see it referred to, will have left your estate and will no longer be counted towards your potential inheritance tax bill. So let's imagine that Roger and Rebecca decide to give Ron and Rachel £500,000 each. The kids open up their Christmas cards to be each greeted by a fat cheque instead of another pair of those garish socks. If Roger and Rebecca live for 7 more years, which, given their mid-60s, is a pretty good bet, this £1 million won't be theirs anymore and therefore won't be counted in their estate for inheritance tax purposes, potentially saving £400,000 in tax at the end. However, If they were to die within 7 years of dishing out the money, these gifts will use up their nil rate band, although depending on when they died, they may be subject to taper relief. I know, what's taper relief? This relief reduces the amount of IHC due on a gift, starting at 3 years and increasing until the full 7 years have passed. I can't get bogged down in that in this video, as it is a little complex, and there's more info on all that here. And just before we get on to this next tip, the purpose of this video is to give you enough information to manage these things yourselves. But retirement and inheritance tax can be complex issues. As well as being a YouTuber, I am a regulated financial planner with my own company. If you'd like more professional help and to make sure you're managing things in the most tax-efficient way possible, there's more information in the description on how to apply to work with me. And if you have more money coming in than you need to live on, you can give away the extra cash on a regular basis without worrying about inheritance tax. This is known as the normal expenditure out of income exemption. However, for gifts to qualify, they must be made from income, not capital, and leave you with sufficient income to maintain your normal standard of living. And there must be a pattern of regular giving. Separately, and in addition to this, you also have an annual exemption of £3,000 a year per donor, which can be used for gifts. To be clear, this isn't £3,000 to each person you want to give money to, it's £3,000 total allowance you have as a donor. You could give £3,000 to one person or 3 people £1,000 each, for example. So let's imagine that Roger and Rebecca realise they can afford to give Ron and Rachel £500 each, so £1,000 in total, each month from their pension income using the normal expenditure out of income rules. And they also each use their £3,000 annual gift allowance, so £6,000 a year total for them both. This is £18,000 a year. And if we say they did this for 20 years, we'd add up to £360,000 given away tax-free, potentially saving £144,000 worth of inheritance tax. There are more rules on regular gifting, like small gift allowance and gifts for weddings, etc., all here on the HMRC website if you want to look through. They are there to be taken advantage of, and most people don't use them and aren't even aware they exist. Now, number 5 is a bit of a strange one because it's only going to work for the next few years. So sorry if this sounds a bit morbid, but if you are definitely going to pass away in that time frame, it's still a tax hack. But for anyone else, recent budget changes have closed down this benefit. At this moment in time, any money held in a personal pension is not included in the value of your estate when you pass away. So up until now, maxing out your pension contributions was a great strategy, which lots of people have taken advantage of over the years. However, in the recent budget change, Labour announced any unspent pension money in these personal pension pots will be included in your taxable estate starting from the 6th of April 2027. In other words, your pensions will no longer be protected from inheritance tax. So, if you have been carefully putting money into your pension over the last 20 to 30 years in the hope of passing it down to your kids, what can you do? Well, firstly, don't suddenly write pensions off. Remember, they are at their core a retirement asset, so it still makes sense for you to contribute and build wealth in pensions. This change doesn't impact that. However, if you're in the camp where you're squirreling money into a pension to use it as an inheritance tax shelter, then think again, because that ain't going to work anymore come 2027. Secondly, you should start to have conversations about what your new inheritance tax situation will look like with your advisor, and perhaps maybe consider spending a bit more from your pension. Should be a discussion. But thirdly, and most importantly, don't panic. Nothing has actually happened yet. The change is still under consultation, so it could end up slightly different, or Labour might come out of government, the Tories reverse it, and we're back to square one. Stranger things have happened. I guess what I'm saying is avoid making rash decisions and educate yourself as to what this change means and how it impacts you. So, let's assume that Roger and Rebecca listen to my advice over the next few years and restructure their assets as per my suggestions. Rather than sitting on a £4 million estate, assuming pensions are now in their estate post-rule change, which after the nil rate bans are applied, would give rise to a £1.6 million inheritance tax bill. They will instead have spent £500,000 on amazing experiences, creating lasting memories with their family, gifted £1 million to Ron and Rachel over 7 years ago, helping them while they can still also see the benefits, and given away £360,000 through regular gifting over 20 years. If Roger and Rebecca both pass away in the next year, their new estate value is now £2.14 million. And after applying their total £650,000 nil rate bands, their taxable estate is now just £1.49 million, and this results in an inheritance tax bill of £596,000, which is then covered by their life insurance policy. The end results? Ron and Rachel will have inherited the full £2.14 million plus any excess from the insurance payout without paying a penny in inheritance tax. Don't forget, they've already had loads of gifts too along the way, so some of their mum and dad's estate they've already inherited in advance. Meanwhile, Roger and Rebecca have enjoyed their retirement to the fullest and had the satisfaction of helping their children during their lifetime. In other words, Roger and Rebecca can have their pie and eat it. Oh, why didn't I do this with pizza? However, it's all well and good leaving money for others and thinking about their future, but what about you? What do you need to start thinking about now so you can live your dream life in retirement? Well, check out this video next where I break down exactly how to do it. Cheers.